Hello and welcome to Pro Trader Strategies Market Commentary for Monday, March the 23rd. I'm Eric Wilkinson. I'm here to talk about the economic, geopolitical, and market analysis, but then I also layer on top of that option strategies that I'm using to implement into my portfolio to increase my overall probabilities of success. I do webinars where I drill down on the different mechanics that need to go into each and every strategy in order to be successful. I kind of breeze over that here in these daily market commentaries, but it's up to you to implement these strategies into your portfolio in your own way, according to your own risk parameters and market assumptions. We're not here to teach you guys just to go and implement what I'm doing. It's up to you guys to take this information and build a strategy appropriate for your risk parameters. All right, so without further ado, let's get on with the economic data. Across the pond, not really a whole lot to see here, nor here in the United States, as it is a Monday. The markets are moving all over the place, and that is because what happened was, the emergency economic stimulus package got denied last night, so it sent the markets limit down at one point, or actually several points. They went limit down in the futures. Market's starting to recover a little bit, but we are not looking like we are going to have a positive day here in the United States again. All right, crude oil starting to lose a little bit of strength as the day goes on here, down 76 cents. People are talking the teens for crude oil, and I even heard one analyst say that we could see negative crude oil prices, meaning that people need to sell it for less just to get that inventory moved. I don't know if we're going to see that. That seems a little bit far stretched, but that is something to keep an eye on, that if there is so much supply out there during a time of people being on lockdown, which means if you're on lockdown, you're not driving that car anywhere. Well, that means the lack of demand coming from the crude oil, and we're seeing manufacturers shut down, like some of the big car manufacturers shutting down. That means that there is no demand from the manufacturing sector, which is a major driver of the demand of crude oil. So we could start to see these markets really slide. Gas at the pump will be super cheap, trying to beg people to get out of the house, but when you're on lockdown, you can't. All right, so it's a bit of a conundrum, to be quite honest. So where crude oil goes is not likely straight up at this point. Gold futures are making that big move, up $65 today. A lot of, I think, this selling pressure where people were selling out of the precious metals and rotating it into the equities over the past weeks or so was the reason why we were seeing gold futures come off. We are still seeing the equities come off. That retailer and stuff like that isn't enough buying pressure to come in there as we were seeing the equities come off. But I think that was a catalyst for seeing gold come down, was that people were kind of rotating out of that and getting into some of the equities as they are nibbling in this bear market, adding to portfolios, similar to what I've been doing, but not selling gold necessarily. All right. Bonds are up on the day by 2 points. Again, off the highs. It looks like that the bonds have had a bit of a pause type pattern here. I think that the bonds are going to continue to move a little bit higher. I don't know that we're going to go a whole lot higher, but I do think that the bonds are going to continue because the Fed is talking about coming in and buying bonds like they're going out of style for the most part. So it doesn't seem like there's going to be an end in that kind of support. So we'll keep an eye on that as well. VIX is moving a little bit higher, it's still in the 60s. You would think that was going to be a 16, but no, it is the 60. That's where we are finding the new normal here. And we've got the Dow Jones Industrial Average futures. These are the futures, down 740 points. As you can see, we are off the lows, which was created overnight, like almost off of the open. The market went limit down based on that, the stimulus package getting turned down by the Democrats. So that caused this market to go down. Some people are saying it was because it was a slush fund for Trump and all his buddies that are in the cruise line industry. They didn't want money going to them because they've people like Disney have set up the Disney cruise lines are offshore businesses. So they don't pay taxes to the United States because they've set up that offshore business. Now, I kind of agree with that, if they've kind of straddled or gotten around the red tape for paying U.S. taxes, that we shouldn't necessarily be bailing those guys out. So I do see a bit of their point, but it was seeming like they were agreeing to all of these things going up and into that ahead of time. So it was a bit of a slap in the face when it didn't go through, and that really caused the market to come off. So if they can't come up with these stimulus packages where people are going to get some money, we're seeing unemployment rates already start to spike by 30% in some areas. That is going to be a cause from all of these part-time workers that are at restaurants or other places like that are getting shut down and aren't able to go into work. Even the in any type of entertainment industry, I should say. So that massive slowdown is going to cause unemployment to spike. Now, there's got to be a balance here. I understand that everybody's trying to flatten that curve on this spreading of this virus, but at the end of the day, some people have got to be working and doing things in the economy in order to generate money for purchases of other things. Otherwise, we are going to be talking about the great global depression of 2020. So that's something we're going to have to start really keeping an eye on. Yes, if you are at a high risk, then yes, you should be staying at home and quarantining. But if you are of healthy stature and healthy, I should say, if you're just healthy and don't have a lot of pre-existing conditions, then those people should be able to go into work and spend money in the economy, to be quite honest. And yes, it will kind of cause that curve to spike a little bit, but the balance is we crash the global economies and cannot recover for 10, 20 years. Therefore, people will be starving and everything else, and that creates famine. And when famine happens, then health problems start arising, which will allow this coronavirus to get worse. All right. So where do we draw that line is something that people are really going to have to start struggling with going forward. Now, NASDAQ is off by 34 points. The tech sector was one of the areas that was staying in positive territory here, but it has recently just kind of gone into negative territory. If we take a look at these charts, you can see it feels like we're building a bit of another bottom. Now, we aren't confirmed, but say for instance, if the E-mini S&Ps finish somewhere around this area between 2249-ish and the low, it's going to make it with the overnight session look like a very strong bottom there. It would have to get confirmed, obviously, tomorrow, but feels like we're building a bit of a bottom when we're looking at the technical analysis here. And when I'm talking about that, right now we have that green candle as we're seeing here. But if we were to have something where we were looking at a candle where, let's just say it's a green candle like we're seeing right now, something like that looks pretty good, and then you get obviously a green candle that way, that makes it feel like a bottom. You could even have something where you're basically looking at a bottom there with a green candle. Obviously you would have to have the confirmation the next day, but that would indicate that we are at least in a short-term type of bounce scenario. So we're going to be looking at this kind of candle with let's say a green candle there the next couple of days would hopefully get us at least a bounce back towards that value area low that we're seeing right here. So that's where I'd like to see a bit of a bounce. I don't know if we're going to get that anytime soon. We could start seeing something like that because we are in a bearish pattern. We have the bounces kind of like that. But we're going to have to keep an eye on that. I would like to see a candle kind of like this and then get the confirmation tomorrow on something where we get a bit of a bounce there. Anything, if we had a candle today where it looked more like this, if today's candle was that way, it could go really either way. That is not a very strong bottoming type pattern. Finishing towards this one is the one that I would probably like to see the most, as it would show more of like a capitulation type thing where people kind of dumped out of it and got a recovery. Now you can see overnight news coming out that the emergency fund was denied. We got that gap down to the bottom, as you can see, almost immediately on the open. And across the board, this happened even in the Dow Jones futures and the NASDAQ futures, hit those bottom lows. Coming into today, got a little bit of some euphoria as money started coming in before the open, but as soon as we opened the doors, the market has seen nothing but weakness. Trying to cover maybe even just the whole day range, cover that gap from the previous day and things of that nature that we could talk about, that the markets tried to retrace and fill in. But it's just everybody's got a different assumption going on as to what's happening, and that's causing these major volatility swings as people are putting their money to work. All right, Coca-Cola. I decided to go in here. You guys remember a lot of these stocks. I ended up taking a long position in this. In Coca-Cola, I am long quite a bit higher at 53. I think Coca-Cola is a good stock. It's something that people, if you aren't going out to dinner at restaurants, these are things that you're going to be buying and putting in your home in 2-liter bottles or cases and stacking those things up. You know, depending on how long you think you're going to be at home or how much Coca-Cola you need in the house. So I decided to go in there and do a little bit of dollar cost averaging. I'm not trying to double up with this trade, but just adding a little bit at a time, and went into the April and sold some 30 puts in there. So if the market comes down, obviously I would put some more stock at 30, but that would kind of dollar cost average me out a little bit lower. I'm not trying to advocate throwing good money at bad money, being in a bear market here, and I'm long at 53, so I got to, buy lower and keep buying that. But at the end of the day, dollar cost averaging does work. I think this is well overdone, especially for something like Coca-Cola. I don't think that they are going out of business. I'm just trying to stay mechanical, and if I can continue to lower what I paid for those stock across the board, then that's what I'm going to look to do. One of the things with Coca-Cola, I couldn't sell like the 53 calls or anything like that. It was just, they were almost worthless. So I don't want to lock in a loss on this. I'm going to look to manage this risk and continue to lower my basis on it. Then we go over to MasterCard, and in MasterCard, I ended up just rolling my short calls just down. I didn't roll them out in time. I just rolled them down, and I was short the April 300 calls in there, and I rolled those out to, bought those back, sold the 245 calls. And if you guys remember with this trade in MasterCard, I am long right around 242 and a half. And if I go and look at the total breakdown of what I've done with MasterCard on this, if you guys remember, I sold some, the 270 puts and the 215 puts in there. So the 215 puts the 215 puts obviously were hit as well. So that kind of is what caused that dollar cost averaging as well. On that trade, I sold those 270s, the 215, so both those got put to me. A little bit less on the 215 puts than I did at the 270s, but dollar cost averaged me down to about the 245 in there, and then or the 242, and I had sold those 300 calls for $2.68. So total all in on collections of credit with this trade, I was able to lower my credit by about $8 now, a little bit better than $8, $8.50. So when we're talking about that dollar cost averaging by selling these puts, I get to keep that collection despite the fact that I was put that stock, right? So the overall collection of credit drops me by another $8. So I'm at around $2.35 for my break even. Well, I just rolled those 300 calls down to the 245 calls, and I got another collection of $1.77 on that. I'm trying to do a similar thing here with Microsoft is getting away from me, so I just stopped chasing it. But if you guys remember, I've been lowering my cost basis on Microsoft for quite some time by selling some credit put spreads and dollar cost averaging, sold some calls in there as well. And right now I'm trying to roll my 285 calls, sell my 185 calls in Microsoft. That I am long this trade with Microsoft at around on average 160. So you can see that 160 is obviously way up here. I'm also trying to roll my 185 calls, which we talked about this. If it got back up there, I'd be really happy. Well, I decided to roll those 185 calls down to the 160, which is right here. That would still be a very nice bounce. And I was able to, or I'm trying to do it for $1.33, and like I said, it's gotten away from me. It's trading under $1 at this point, but we'll keep you posted as to what happens there. The rest of the things I've got going on, I haven't added anything. I'm just trying to stay mechanical with this, and anything else other than that. Just trying to stay mechanical, lower that overall cost basis like I've done with MasterCard. That's a big lowering of cost basis by $8, you guys. So that is the power of selling options in and around these positions that we're losing money on. Yes, we can still take advantage when the market is coming off there. Selling calls, lower the cost basis. It gives you an extra little dividend, if you will. It's probably not making up for the directional move, but when the move happens and we get that bounce, that's where you're really going to see that start to show up in your P&L after you've lowered all your cost bases on all of these underlines and they start moving in a positive direction. All right, that's about all I got for you guys. Hope everybody is staying safe and staying healthy. Stay healthy, wealthy, and wise. That's what we're trying to teach right now. Stay healthy, wealthy, and wise. Trying to keep you wealthy by making you wise to how to trade options in your portfolio. Everybody's got some stock out there that they're probably looking to manage. It could be in a 401k, you guys, that you're looking to protect as well. So read over this. Keep in mind that nothing is considered investment advice. These are things that I'm doing and trying to teach you guys from what I'm doing how to trade options in an appropriate way. There's different ways to build out option strategies. People online will tell you one way. I'm going to probably tell you a different way, but I explained to you, try to make it obvious as to why I am trading the way I do versus the way that some of those other people are doing it. So please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, so that's about it. Other than if you can't take that, take it easy.